So welcome back to the channel, Quant Apprenticeships. In today's video, we're going to be going through some common investing terms like a bull market and a bear market. These are two terms that you might have heard before, and what I will do, I'll break down what it means and what is sort of how it relates to the stock market. So let's get into it. So what do these terms mean? You might have heard the terms bull market or bear market, or someone saying they're quite bullish or they're quite bearish right now. What these terms mean is if a stock is going up, you would associate yourself with being quite bullish on the stock, saying that you have a positive view, and bearish or bear market is when you sort of negative in a way. It's when you don't see things going as well. These terms are quite generalized terms that everybody uses and everybody knows. So if you want to have a basic understanding of the stock market, there are two terms that you really should know. In this video, I will explain the differences between both of these terms and the impacts that these can have when you're assessing a stock. So what is a bull market or being bullish? It is a period of sustained increase in stock prices. So when the price of a stock is going up, it might go up, go down a little bit, but the overall long-term outlook is positive upwards trending graph. The prices will generally be rising, and this is where, as an investor, you're quite optimistic and you're confident that the stock will go up. You think it's got a positive future. The economy could be strong, could be good growth, good earnings. It's when you're happy to invest in the stock because you're confident that it will go up. So what is a bear market on the other hand? A bear market, or being bearish, is when a stock price will begin to decline, like typically maybe around 15-20% from its highs. It's where you don't see a positive outlook, you don't see the stock growing, you see more declining coming towards the end of its life cycle in a way. It's where the prices are genuinely falling and you're a bit pessimistic, you're a bit fearful because you don't know what's going to happen. This could be because of external effects like economy or what's happening out there like wars. It's where you're not as confident, but you're still invested in the stock. This is where investors tend to sell just because they don't want to sort of risk and lose out on the money. They're trying to plan ahead and not be caught up in this bear market. So what is the difference between a bull market and a bear market? For a bull market, it is when the prices are typically rising, and as an investor, you're quite optimistic, you're quite excited for what the future has to become. It's where the economy is quite strong. So let's say you have Nvidia being a chip producer, it also affects the semiconductors, all the other sort of companies in that sector, just because if Nvidia is rising, they're going to start rising. So that's a bull market. Same with different sectors, how a big company can affect them. It's when the overall market is quite happy and quite strong. A bear market is where prices are typically falling, where the investor is quite pessimistic. You don't know what's going to happen. You're not as confident anymore, and where the economy could be weakening. This could be like the tariffs that Trump recently introduced, or any other external factors. A bull market tends to be longer lasting, just like you normally see a company grow rather than drop on average. Whereas a bear market is where if you still believe in the stock, but you can see it going down for the next couple of months, but you think long term will go back up, this is a nice opportunity to buy the dip. A popular term, buy the dip. So some strategies for investing in either a bull market or a bear market is, as we are long-term investors, we should be looking at investing for the long term. I'm talking 10 plus 20 years, constantly dollar cost averaging investing. We should just stay consistent no matter what happens. If things go down, you can maybe put more money in. If things go up, you still keep investing. Whatever happens, you want to be dollar cost averaging. You want to be putting in the same amount of money over a consistent time period, if that's weekly, if that's monthly, just so your average is the best. If things go up, if things go down, you're getting an average cost. There's no point waiting and trying to time it just because you don't know what's going to happen in the future. So a famous saying within the investing world is timing the market beats timing the market. What this means is you're better off if you done your research and you trust a company, you're better off investing in a company right now today. If you wait trying to let the company drop a couple of percent, what if it goes up a percent and then you've lost out on more profit, your averages become higher just because you're trying to time it. You're better off getting in the market and staying in it for the long term. So factors that can affect the market are supply and demand. A company normally goes up and down because of buyers and sellers of the stock. If it's put out good earnings, a lot of people are going to be buying it, that's why it goes up. So supply and demand is the one big thing. Another big equal thing is economic changes. This could be GDP growth, inflation, interest rates, employment, even other external things like tariffs, wars. These can all affect the market just because the market is so diverse. And the last thing is what people believe, what they when they look at the market, what do they see? What do they think is going to happen? Do they see that as positive? Do they see it negative? Are they bullish on the stock or are they bearish on the stock? These are the things we have to take into account before we invest. Understanding a bull market and a bear market are fundamental to navigating the investment world. They represent the ebb and flow of economic cycles and investor sentiment. These are two terms that are very important when it comes to investing and that everybody should know. Remember to always do your own research before you put any of your capital at risk because the stock market is so unpredictable. So thank you for watching. Remember to like, subscribe and leave a comment. If you like videos like this, let me know I can make more like this, especially towards investment terms. In the description below, I've left a link to a PDF where I go through the complete step-by-step process on how to get an apprenticeship. Thank you for watching.